So we got 5 things that disappear once you retire. And so we're going to talk about what they are and what you can do to make sure that you are prepared for their disappearance. And then the original air date of the program means that we are about 2 weeks out from tax deadline of April 15th, but we're going to let you in on a little secret. If you live here in Florida, the deadline's actually May 1. We're going to talk a little bit about that on the program, along with some moves that retirees and workers alike can do to save on their taxes, some of which is not too late to actually do for that 2024 tax return. And then we're going to have a little bit of a discussion about that Form 1099-K. If you are a regular listener to the program, we've certainly talked about this particular form. More and more people are finding this form in their hands, particularly if they sell stuff online, whether that be through eBay or any Etsy or any of those other types of platforms. This form is getting generated. I actually got one for one of the entities that we are owning. And so we're going to share with you what you got to do in the process that you have to do as it relates to that Form 1099-K when you're selling stuff online these days or through any a variety of platforms. My 1099-K actually came from Ticketmaster. So we will chew all of that here on this week's episode of Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also a top 25 financial planning podcast on the internet. Go ahead and check out our website at Nelson Financial Planning. You'll find that also on the internet. And when you are there, you'll see a bunch of icons. Those will allow you to get connected to our particular channel on your favorite podcast platform, along with our YouTube channel, where you can see me gesticulating with my hands, because when I talk and do the show, I use my hands, even though you don't see that on radio or on a podcast, but you do see that on our YouTube channel. So that channel at Nelson Financial Planning. Again, the website has direct links to all of those channels. Once you get there, make sure you hit that subscribe button, because that means that you won't have to do that whole process again. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of certified financial fiduciaries who stand ready to help you improve your life with a successful and cost-effective financial plan. So before we get to all of that, there were some statistics that sort of found their way across my desk this week, and they all sort of provide some additional perspective of what the markets have gone through so far this year. And I guess you could say what the markets have gone through in the first quarter of the year 2025, because there's only one more business day for the quarter itself. And that, of course, is Monday. So I guess for our purposes, probably pretty close enough that Q1 is effectively in the book. So 3 stats. So we'll start with number 1. A lot of the decline or the volatility that we have seen in the stock market as a whole so far in quarter 1 has been relatively concentrated. And sort of, let's face it, the performance of the market over the course of the past few years has also been pretty concentrated. We've certainly talked about that in prior programs. If you look at the Magnificent Seven, as they are described by the mainstream media, so that is Apple, Amazon, Alphabet, which is Google, Meta, which is Facebook, Microsoft, NVIDIA, and Tesla. So those 7 companies, often referred to as the Magnificent Seven, their performance or their contribution to the overall performance of the market really has been very highly concentrated, meaning that those 7 companies have driven a lot of the performance of the overall market. In fact, at year-end 2024, those 7 companies had contributed over a third of the performance of the entire S&P 500 for the prior year. As the name suggests, the S&P 500, that would mean that there's 500 companies in the index, but you only got 7 companies that are actually contributing a third. So you can see the concentration or the disproportionate impact that those companies have on the overall index. So we've been talking about this on the program for some time. That level of concentration is a reason to be somewhat cautious on what your overall investment allocation looks like, because when you get that concentrated, and there's times in history when a small handful of companies can in fact drive so much of the market, particularly when the S&P 500 is a market cap weighted index. So the bigger the company is, the better it's doing, then the more it's going to drive the performance of the index. It doesn't necessarily end well. Certainly when that happens, correspondingly, your portfolio, particularly if it is in a bunch of index funds, or maybe it's in a bunch of funds that are kind of closet tracking the index. And lots of funds out there claim to be, active and managed and all of that. But at the end of the day, if you look at the allocation, they're kind of just closet indexes. So you really have to be careful about this. And so we've been talking to people about really looking at their underlying investment allocation. And certainly the stats on the first quarter of the year help to shed light on that. Those Magnificent 7 companies are down over 20% from their high in December. Meanwhile, an equal weight of the 500 stocks in the S&P 500 down just 7% from its peak. So that difference, 20 versus 7, clearly makes a big difference in your portfolio. More specifically, if you look at sort of that period of time where volatility really spiked, in that 30-day period from mid-February to mid-March, those 7 Magnificent 7 companies during that period of time were down an average of 16% versus an average decline of about 5.5% for the other 493 companies in the market. So the key takeaway on this stat is you got to double check your concentration on an individual stock level. It's not enough to say, oh, I own a bunch of funds and life is grand. You've really got to take a little bit deeper dive on what it looks like, because at the end of the day, it's going to show up on your first quarter statement that you will get at the end of this coming week, most likely, or the beginning of next. If you look at your first quarter statement and it is down a lot, then you probably have way too much concentration in those Mag 7 large growth, large tech companies. If your statement for the first quarter is basically flat or maybe even up a little bit, then congratulate yourself. You've got a pretty broad and decently diversified portfolio. The reality is that balanced funds, bond funds have actually been slightly positive for the quarter, and international funds in particular have done even better. So once again, kind of emphasizing the notion of being fully diversified in terms of your portfolio. The second statistic that came across my desk has to deal with investor sentiment. And as we talk about this, I want you to remember the famous quote from Warren Buffett that said, "Be fearful when others are greedy, be greedy when others are fearful." Well, fear is at a pretty high level, especially on a historic basis. Investor sentiment is very much at perhaps one of the peaks that we have seen in terms of negativity. Of course, that usually correlates to the fact that the worst of the market decline is actually behind us. Here's the stat. As of March the 20th, according to the American Association of Individual Investors, bearish sentiment came in above 55% for the record 4th straight week in a row. Since 1987, the only other time that bearish sentiment reading was even above 55% for 3 straight weeks was the lows of the financial crisis. We're going to take a break and continue this part of the conversation because we got one more stat we want to show you just for some comparison purposes as we close out the first quarter of 2025. We'll continue after these messages here on Dollars and Cents. Sharing with you on the program some statistics that sort of came across my desk this past week, which I think gives some perspective, if you will, as to what's happening, particularly as we close out the first quarter of 2025. Technically, there is one more day left in the quarter. And as we were sharing in that first statistic, it is a lot of the decline that has happened, or a lot of the volatility that has happened during the first quarter of this year is quite concentrated, much like the markets have been concentrated sort of on the upside over the past few years with this collection of Magnificent Seven companies. A lot of the volatility is finding its way in just those Magnificent Seven companies as well. The statistic that we shared is for that 30-day period from mid-February to mid-March, where you sort of saw volatility really increase in sort of that window. Those Magnificent Seven companies were down an average of 16.4% versus an average decline of just 5.6% for the other 493 companies that make up the S&P 500. So pretty dramatic on that. The second statistic that we were sharing is the notion of investor sentiment, right? So when investors get very negative, more often than not, it is when things are at the very worst, meaning that usually their sentiment spikes right about the time where the market is kind of hitting the worst of the worst. That is certainly seems to be the case when you look at it on a historical basis. Of course, Warren Buffett best sums it up in his quote, "Be greedy when others are fearful. Be fearful when others are greedy." Right now, people are pretty fearful. And in fact, a record fourth straight week, according to the American Association of Individual Investors, bearish sentiment came in above 55% for a record fourth straight week in a row. The only other time that bearish since 1987, so this statistic goes back quite a bit, the only other time that bearish sentiment was even above 55% was the 3 straight weeks at the financial crisis lows in March of 2009. Let's face it, if you could invent a time machine and go back and invest in March of 2009, you would have been doing really, really well. So I guess some perspective on that. Frankly, to be candid, a little surprised about the excessive negative sentiment of the investing public these days. Because the diversified portfolio is showing signs of life, as we were saying in the first segment. Balanced funds are up for the year. Certainly, bond funds are up. International funds are up. So, maybe your large tech stuff is down, but a diversified portfolio allows you to weather that pretty well. So it is interesting. As we sit and visit with clients, they're thinking, oh, big calamity in terms of the value of the account. But the reality is that a diversified portfolio that's been rebalanced along the way is weathering through decently enough. If you're looking at your first quarter statement and saying, what's this guy talking about? My first quarter statement looks like a disaster. Well, then might be time to go over to our website at Nelson Financial Planning and schedule a free consultation and a free review of exactly what is in your portfolio, because the reality is that there is a good bit of economic data that, a low unemployment, high levels of cash on the sidelines. Toss in the latest industrial production numbers, which actually hit an all-time high for the first time in 76 months, going back to September of 2018. And maybe there's a little bit more to the story economically that's happening behind the scenes than kind of some of these headlines that everybody is kind of getting fixated on. Number three, statistic number three, I said there was three. So the S&P 500, obviously during the course of the first quarter of 2025, entered a correction. We talked about that last week on the program. For those of you who missed it, a correction, the technical definition of a market correction, is when the market declines by 10% or more from its all-time high. So there was a 16-day trading period from like mid-February to mid-March that we were referring to earlier, where the S&P 500 sort of went into that correction territory. The reality is that 16 trading days, that sounds like really, really quick, but in fact, that didn't even make the top 10 quickest market corrections in the past 50 years. So just a little perspective goes a long ways. Here's the last stat that we've got for perspective purposes. So the 55 times, so 10% correction in the market has happened 55 times since the year 1952. So over the past 70 years, which, you would say, well, my goodness, those happen somewhat frequently. That's kind of part of the normal market. But what's interesting about this stat is of the 55 times that a market correction has happened over the past 70 years, only 1 in 4 hit the 20% mark. So that means that 75% of the time, once you go through a market correction, things recover. So before you jump to a lot of conclusions as to what the rest of the year might hold, we encourage you to think about these statistics. Bottom line, obviously stay tuned, right? For the next 3 quarters of the year, there'll be certainly plenty of things to talk about as the year continues. But the key takeaway, of course, folks, is make sure that you have that diversified, balanced portfolio that is getting rebalanced along the way. That time and time and time again is the best way to sort of navigate through whatever the world may dish out. And certainly that is showing itself very much so these days as well. So important stuff there. So we'll shift gears. You've heard Kristen Costello on the program. She is one of our certified financial fiduciaries, also happens to be a certified financial planner and a CPA. The girl's gotten more initials than anybody else I know at this point. But we've talked about this 1099K, okay, this complication that is coming. And not coming, it's here. I'm looking at a 1099K that I am going to have to deal with from the good folks at Ticketmaster. So what is that form all about? What do you need to know? Bottom line, the form 1099K is a report of payments that you received for goods and services during the year from maybe it's payment cards or payment apps or online marketplaces. So any of those types of things, basically online kind of activity. Those organizations are all required to fill out the form 1099K and send a copy to you, and more importantly, for your tax purposes, send a copy to the IRS as well. So both you and the IRS have the information. Those payments generally are reported directly from those providers. You use form 1099K with your records of what you actually sold online to figure out exactly what your taxable income is. The form 1099K shows the total amount, the gross amount of all of the payments that you received. It does not include whether there was fees associated. It doesn't include whether there was refunds or credits or shipping costs or any of those kinds of things. It just has the gross payment amount. So now you start to kind of think, oh, well, I could see where then there might be some trouble with that, because if it's showing the gross, well, at the end of the day, you're only paying taxes on the net. So what's going to happen as you start to see this form. So we will talk more about that Form 1099-K and what you need to be doing it and doing with it, and give you the very specific example of what we're having to deal with on our own as we stare at a 1099-K from Ticketmaster of all places. We're going to take a break and continue here on Dollars and Cents with Joel Garris of Nelson Financial Planning. We're talking about 1099-Ks. That is the form that you get from payment card companies, payment apps, online marketplaces, all of that. They are required to send you a 1099-K if the payments that you receive for any goods and services that you sold on those platforms exceeded $5,000 for the year 2024. Now, here's the kicker. This threshold is continuing to shrink. For 2023, for example, you needed $20,000 of gross sales and 200 transactions in order to get this 1099-K. Now, the 1099-K, it's $5,000 of a threshold, and it doesn't matter how many transactions. It could have been just one transaction that was a large transaction, but you're still going to get that Form 1099-K. For this year, 2025, that $5,000 number shrinks to $2,500, and in 2026, it gets to the ultimate level of where the IRS had pegged the requirement of generating that 1099-K at $600. So it's going to really start to shift and pick up more and more people as that number drops down. Now, regardless of whether you received the form, you still have to obviously report, income from selling goods and services. But if you got the form, you really kind of have to do it because the IRS also got a copy of the form as well. So when you get the forms, a few things that you want to do right out of the gate. Obviously, check the information on the form, make sure it's applies to you, and that the gross payment number looks at least familiar. Now, remember, it's a gross payment number, so it hasn't been adjusted for any, fees. It hasn't been adjusted for any shipping costs. It hasn't been adjusted for anything. That's just the gross number. Now, what you're then going to have to do is to use your records. You're going to have to compare the gross payment amount on the forms with the amount that you actually got, how much you had of expenses of, say, the credit card processing fees, any of the refunds, any of the shipping costs, all of that then lines up against that gross amount. And then you have to report all of that as basically effectively a business that you would typically report on Schedule C. That seems to be the most likely place where to put this information for most people. It sort of depends on the type of transactions that you made, but generally for goods and services and things like that, that would be Schedule C. So let's talk through a real life example so that you can hear just how convoluted and how big of the process is to actually file this correctly based on the current IRS rules and regulations. It's a real PETA, if you will. If you don't know what that acronym stands for, then you should Google it. So I have a 1099 from the good folks at Ticketmaster. That comes as a result of, for many years, actually since the Orlando Magic first came in to Orlando, the family, starting with my father-in-law Jack Nelson and his wife June, been season ticket holders since the very beginning. And these days, there's like 41 home games, and sometimes shared between family and friends and coworkers and all of that. But then there's some games where, it's just not possible that, they're going to get used. So we go ahead and just, throw them up on Ticketmaster and sell them. That's probably kind of the easiest way to do it, or at least from our perspective. And so we did that during the course of last year. And then it the total amount of the tickets sold, it's a handful of games, it still, was above the $5,000 threshold. And when you look at the 1099K, it breaks out not just the gross amount, but then it breaks down how much you got in each particular month. So obviously, not selling Magic tickets in, like June, July, and August and September because there's no basketball games. But okay, there's some money for January, there's some money for March, there's some money for December. All of that is detailed under each of the individual months that appear on the 1099K. So now what I need to do is to research and match up those gross amounts with every ticket I sold, what I paid for it, and then, whatever the cut was that Ticketmaster did when you resell tickets, which, their cut's pretty significant because, again, these numbers show the 1099. Now, here's where it gets crazy, should I say, bordering on insane. So I have games, right, on this 1099K that I made a profit on, right? So like if I was selling a ticket to the Lakers game, right, you bought it maybe for $200, able to sell that for $300, right? Because Lakers popular, and then Ticketmaster gets their 15% cut, so that's $45. So I'm looking at on that particular ticket sale, I'm looking at a gain of $55. Okay, so I have to report that, and given that the gain it's going to be short term because just got the tickets at the beginning of the season, so it's not more than a year. It's a short term gain. Okay, it's going to be ordinary income, and even with that, because most of this is getting funneled onto Schedule C, that's always going to be ordinary income as well, because the gain loss concept, the IRS doesn't really like to have that applied on this. They really do view this more as a business activity when you are reselling tickets or reselling anything, whether it's Etsy or Amazon or whatever the case may be. So now I have this business of ticket reselling, I guess. So I'm going through, I'm matching things up. Okay, fine. The Lakers made money on that, so that's $55 in that particular example they were given of income. Okay, here's where it gets crazy. So, there's other teams like the Pistons that aren't very good and, aren't going to generate a whole lot of attention and attraction. And so on those, okay, bought tickets for $200, sold them for $100, okay, because it's the Pistons, or let's just say $150. I sold them for $150, less the $25 that went to Ticketmaster, because again they got to get their cut. So on those, I actually lost money. I lost $75, but I don't get to use that because that loss, according to the IRS, does not offset the gain from the Lakers tickets, because each one of these transactions are done on an individual basis. So if you sell item X and you make a profit, you have to report that. If you sell item Y and you make a loss, you don't get to aggregate them together based on the current rules for how this 1099K is supposed to work. If you think that's crazy, you would be correct, because it's essentially the same thing, right? It's tickets to the Orlando Magic, sold one, made money, sold the other, didn't make money, but based on how the IRS code works, you don't get to offset those. I kid you not. This is okay. So this is a issue of significance, I would like to think, because it's a bit of work to put all of that together, and you have to do it on an individual item by item basis. You can't just aggregate, lump it all together. Those are the tax rules. So this one, I think, folks, needs to get cleaned up and clarified. Particularly as the threshold keeps going down, right? So more and more people are going to get this tax document. So bottom line, be very careful if you receive this form. This is very tricky territory that you're going to spend some time on having to deal with on your tax return. With that, we're going to take a break here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So one of the things that people kind of, I guess, don't realize when you get to retirement is that there are a few items that are going to disappear from your life once you retire. And in this segment, we're going to talk a little bit about what some of those are and how best to deal with them. Certainly not having a plan of action would be on that list, or not having a tax plan like we've talked about in prior shows this year can undermine your retirement, along with just simply not having saved enough. All of those are pretty significant. But the 5 things that we're going to cover in this segment really apply to anybody as they transition from the workforce to retirement. And so first off would be, I guess, the regularity of the paycheck, right? That financial security that comes with that paycheck coming in to your bank account like clockwork, right? On a regular basis. And, once you retire, obviously you need to manage your withdrawals from your accounts and make the best decision involving Social Security and other income sources that you have. So what you're doing there is transitioning from accumulating to ultimately spending that money. And it's so important to create a solid income plan in order to be able to make sure that you're going to be able to replace the income that you will lose once you retire. And that sort of gets us into the second item, which is that I suppose one of the things that disappears when you retire is some of your ability to take risks, right? I mean, if you're working, you can probably take a little bit more risk when it comes to your investments because, you're not relying on them to cover the mortgage. You're still collecting a paycheck. Obviously, retirement changes the picture, and market downturns can certainly have a much more dramatic impact on your portfolio when you're taking money out, right? I always give them easy math example of if someone goes down by 20%, okay, and you're still taking out the same amount of money, it's like you're taking out 25% more in order to get that same amount of dollars. So it's important to think about your investment allocation and obviously start to gradually shift that as you start to get closer to retirement. And I guess one of the most important things to be thinking about, is something that we talk with our clients a lot at Nelson Financial Planning, is that make sure you're getting your income from the places that it makes sense given the current climate, right? So another way of saying that is, look, if the market is doing well and up, you would want to take your income from the stuff that is perhaps more growth or aggressive growth oriented inside your portfolio. And then when the market is down, you would want to shift that over to taking that income out of the stuff that hasn't gone down as much, recognizing, of course, the impact of if I take money out, the account is down, I'm going to have to take more shares out to get the same amount of money. So important at the end of the day to kind of have that balanced and diversified portfolio in order to make sure that you've got that flexibility to be able to do that. If you are unsure of whether you have that, well, then we invite you to check out our website at Nelson Financial Planning and schedule one of those free consultations as well. And of course, as you know, if you're a regular listener to the program, if you come into the office for that face-to-face conversation, you also wind up being able to get a free copy of our book, Next Gen Dollars and Cents. We mentioned it earlier when we first got this accolade, but it is coming up very quickly, where our book, Next Gen Dollars and Cents, is going to be featured at the Los Angeles Times Festival of Books. A very nice honor for our book, selected by a board of editors after a pretty competitive editorial evaluation. As I have said on the show, I don't know if it was necessarily the quality of the writing, but maybe really more the topic, right? Because so many people really struggle with their finances. And I think it's important to just provide that baseline education of all of those various financial topics that we cover in the book Next Gen Dollars and Cents. Available on Amazon as well if you just want to pay money for it. I think those guys are still charging $14.99, but of course, with a consultation at the office, you can get your copy for free. So next up on the list of things that sort of disappear once you get to retirement. And we've certainly talked about this one on the program, that notion of the perception that you lose sort of your sense of purpose. And I know earlier in the year we talked specifically on one of the programs about how that impacts men more dramatically, but it ultimately impacts everybody. There's a lot of routine and a sense of appreciation that comes from going to work on a regular basis, along with a lot of medical studies out there as well that say, you know what, there's some benefits to working rather than sitting on the couch and not doing anything in the alternative. So make sure you have a plan, it's almost like a life plan, if you will, of how you're going to spend your time, because you want to have that in addition to a financial plan when it comes to your retirement, because you're going to want to make sure that you have a purpose when you retire. And then, of course, number 4 on this list of 5 things that you're going to lose when you retire would be you're going to lose all those employer-sponsored benefits. Now, oftentimes people think, oh, the health insurance, and I have to focus on that. And that is true. That's the biggest issue. And the sticker shock on that alone, if you're under age 65 and not eligible for Medicare, can be pretty significant. But most employers also offer sort of a host of other things, right? Maybe it's dental, maybe it's vision, maybe there's a prescription drug plan. And so you really do have to kind of plan for those expenses in retirement, make sure that you have properly budgeted and accounted for those, because obviously those become a very significant part of the things that you're going to need to spend money on in retirement. And then lastly, your spending habits themselves are going to shift dramatically in retirement as well, particularly in the first few years. And this is the part that I think people kind of get backwards. They think that their expenses are going to go up dramatically in the last years, but the studies have all concluded that the expenses actually go up more in the first few years, simply because that's when you're younger, you're more active, you're more physically able to do things, travel, all of those kinds of things, versus it sort of at the end years, if you will. Well, okay, probably doing a lot less. And so consequently, your need for extra money goes down as well. So certainly recognizing those differences along the way. Bottom line, retirement is certainly filled with many, many changes. And it's important to recognize, understand them, and have a game plan for them as well. Those are the kinds of things that we do every day at Nelson Financial Planning. So make sure you visit our website at Nelson Financial Planning to learn how we can help you, along with scheduling that free conversation. So as we said at the top of the program, roughly 2 weeks out from tax season here in Florida, we'll let you in on a little secret here at the end of the program. The actual deadline for Florida is May 1. Due to the hurricanes and all of that, there is a shift of that date. Now, at our office, we're kind of sticking to the April 15th deadline because it just becomes a little bit too arbitrary to move that deadline around. I think 3 of the last 6 years, that deadline has been moved around for various reasons. Obviously, COVID, 2020, I think it moved to like mid-July. 2021, it was like mid-May. So you've had a bunch of years where they, kind of keep shifting the deadline. I think for our planning purposes, we're kind of focusing on that April 15th deadline. But there's the little secret. Know that if you are a Floridian, then you technically have until May 1 to file your federal tax return this year. So if you're starting to sweat a little bit because there's only 2 weeks to go, well, you probably want to hold yourself accountable and keep sweating and try and get it all wrapped up by April 15th. But in the back of your mind, yeah, you got extra couple weeks on this one as a Floridian. So with that, we're going to wrap it on up and get on out of here. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning. Be sure to visit our website this week at nelsonfinancialplanning.com to see how we can help you.